Hey everyone, and welcome. Today we're diving into a topic that's close to every business owner's heart: optimizing your company cash flow. We're joined by a true expert in the field, ready to break down the key takeaways from Optimizing Company Cash, a guide for financial professionals.
It's a fantastic resource, packed with insights.
This deep dive is like your cheat sheet, your shortcut to understanding those crucial but sometimes complex strategies for making your cash work harder. And one of the first things the book tackles is the difference between how accountants and cash managers approach finances. It's a distinction that might seem subtle at first, but it's actually pretty crucial.
Oh, absolutely. It's a completely different mindset. Accountants, they're all about the accruals, right?
Mm.
They want to see when revenue is earned, when expenses are incurred, even if the actual cash hasn't changed hands yet.
Living in that world of spreadsheets and balance sheets.
Exactly. But cash managers were wired a bit differently. We need to know when that money is actually hitting the bank account and when those bills are coming due. It's about managing the ebb and flow, making sure there's always enough liquidity to keep the engine running.
It's like the difference between knowing you have a big paycheck coming at the end of the month versus making sure you have enough cash in your wallet to buy lunch today.
Perfect analogy.
Hmm.
Both are important, of course, but it's that immediate cash flow, that day-to-day liquidity that keeps a business afloat. And that's why understanding your company's cash flow timeline is absolutely essential.
The book really emphasizes that. How would you explain the concept of a cash flow timeline? What's the best way to wrap our heads around it?
Think of it as a roadmap for your cash. It shows you when you expect cash to come in, from sales, receivables, all of that. And equally important, it maps out when you anticipate cash going out: payroll, rent, inventory, those recurring expenses.
It helps you see those peaks and valleys, those times when you might be flush with cash versus those leaner periods.
Exactly. It's about anticipating those fluctuations so you're never caught off guard.
Now, speaking of cash flow and anticipating changes, there's a pretty interesting development happening in the world of banking regulations that could have a big impact on how businesses manage their cash. It has to do with something called Regulation Q. Are you familiar with that?
Oh, Regulation Q.
Yeah.
A blast from the past. It's been around for ages.
It does ring a bell, but to be honest, I could use a little refresher.
Well, back in the day, Regulation Q prevented banks from paying interest on corporate checking accounts.
Interesting. So businesses weren't earning any interest on the cash they had sitting in their accounts?
Nope, not a penny. And that led to this whole practice of companies trying to maximize what's called float.
Right, float. That's the time it takes for a check to clear, right?
Exactly. Companies would try to stretch out that float period as long as possible because that money was still technically theirs, even though it was kind of in limbo. They might even invest those funds overnight to try to squeeze out a little extra return.
Clever, but it also sounds like a lot of work.
It was. But here's where it gets interesting. The book mentions that there are actually multiple bills in Congress right now that are aiming to abolish that last piece of Regulation Q.
Really? So we might actually see a future where businesses can earn interest on those operational funds just sitting in their checking accounts.
It's a real possibility. And it could completely change the game when it comes to cash management.
It's amazing to think that something as seemingly simple as earning interest on a checking account could be such a game changer. But that's the power of smart cash management.
It's about maximizing every dollar, squeezing out every bit of efficiency. And this potential shift with Regulation Q, it just highlights how important it is to stay informed about these developments because they can have a real impact on your bottom line.
It really highlights how the financial landscape is always shifting. It's fascinating. But let's dive back into our book, Optimizing Company Cash, because there's a ton of actionable advice in there. Chapter 6 and 7 particularly caught my eye. They're all about optimizing those incoming dollars, specifically around accounts receivable.
Yeah, accounts receivable. That's where the rubber meets the road for a lot of businesses.
It's easy to think of it as just sending invoices and waiting to get paid, but it's so much more than that.
It's a whole system.
Hmm.
And it all starts with attracting and vetting your clients. You need to make sure they're good for it. Credit worthiness, that's the term the book uses.
Right. Making sure they're going to pay you on time every time. And I noticed the book uses an interesting term, cash inflow, float. Honestly, I hadn't really thought about that concept before.
It's one of those things that can really sneak up on you if you're not careful. Basically, it refers to the time lag between when you deliver a product or service and when the actual payment lands in your bank account, ready to be used.
Okay, so it's not just about getting the invoice out the door. There are all these little steps along the way.
Exactly. Think about it. You send the invoice. Maybe there's a bit of back and forth, then they process it on their end. That all takes time. And then, of course, you've got the actual processing time within the banking system itself. All of those little delays add up.
It's like a relay race where each handoff takes a few extra seconds. Before you know it, you've lost precious time.
And time is money, especially in the world of cash flow.
For sure. So how can businesses get a handle on this and speed things up? What does the book suggest?
Well, they have this really neat framework they call the 5 C's of credit evaluation. Basically, it's a way to systematically assess the creditworthiness of potential clients.
Okay, love a good framework. Break it down for me. What are the 5 C's?
So you've got character, capacity, capital, collateral, and conditions. Sounds like a mouthful,
Yeah.
but it's actually pretty intuitive.
All right, I'm intrigued.
So character, that's all about their track record. Do they pay their bills on time? What's their reputation in the industry? Capacity is about their ability to actually repay the debt. Do they have a steady cash flow? Can they handle the payments?
Makes sense. You don't want to extend credit to someone who's already stretched too thin.
Exactly. Then there's capital. This refers to their overall financial resources. Do they have a healthy balance sheet? Do they have assets? And collateral is anything they can offer as security for the debt. If things go south, do they have something you can, hold on to?
Right, like some kind of insurance policy. And what about conditions? What does that refer to?
Conditions are more about those broader economic factors that could come into play. Maybe their industry is in a downturn or there's some uncertainty in the market.
So it's like taking a holistic view of their financial health, not just a snapshot in time.
Exactly. It's about making informed decisions. And the book suggests using a credit scoring model as a way to streamline this whole evaluation process. You assign points based on different factors, and it helps to kind of standardize your credit decisions.
I like that. It takes some of the guesswork out of it. You're not just relying on gut feeling.
Exactly. And then once you've extended credit,
Sure.
it's all about managing those collections efficiently. And this is where the book gets into the nitty-gritty of optimizing that whole process.
Because even with the best clients, there can be delays, right?
Oh, absolutely. And one of the things the book highlights is the fragmented nature of the U.S. banking system. So many different banks, different branches, different processing times. It can create bottlenecks.
Right. It's not like everyone banks at the same place.
Exactly. And that's where the concept of lockboxes comes in. They can be a real game changer when it comes to streamlining your collections.
Lockboxes. Okay, I've heard the term, but to be honest, I'm a little fuzzy on the specifics. How do they actually work?
So imagine this. Instead of having your customers send their checks to your headquarters, which could be miles away, you set up these P.O. boxes, these lock boxes, in locations that are geographically closer to your customers. The bank manages these lock boxes, and as the checks arrive, they process them and deposit the funds into your account much faster.
So it's like shortening the distance those checks have to travel, which in turn speeds up the whole process.
Precisely. And there are different types of lock boxes tailored to different needs. Retail lock boxes, for example, are designed for businesses that deal with a high volume of low-dollar payments, like utility bills or magazine subscriptions.
Right, because you don't need a whole lot of bells and whistles for those smaller transactions.
Exactly. Then there are wholesale lock boxes, which are better suited for larger B2B transactions. And of course, with the rise of electronic payments, there are electronic lock boxes that can handle ACH and wire transfers as well.
Technology is really changing the game, isn't it? It's streamlining so many of these processes. We've covered a lot of ground here, focusing on optimizing those incoming dollars, making sure that revenue stream is flowing smoothly. But of course, cash flow is a two-way street. What about managing the money going out? It's easy to get so caught up in bringing in the money that we forget about managing the money going out. But you're right, those bills, they always seem to find their way to our doorstep.
They do, and that's why optimizing cash outflows is just as crucial as maximizing those inflows. It's about finding that balance, that financial harmony.
So, where do we begin? What are some of the key things businesses should be thinking about when it comes to managing those outgoing payments?
Well, the book really stresses the importance of understanding the true cost of making payments. A lot of businesses, they just look at the transaction fee and call it a day.
Right, like, oh, it's just a couple of bucks to send this wire.
Exactly. But there are all these other hidden costs that can really add up.
Like, what? Give me the inside scoop. What are we overlooking?
Bank fees, for one. Those could be sneaky, especially if you're making a lot of small transactions. And then there are the processing costs, which can vary depending on the payment method. And of course, there's always the risk of fraud.
Ugh, fraud. That's every business owner's nightmare. And speaking of which, the book brought up a pretty alarming statistic about check fraud. Did you know that Ernst& Young estimates over 500 million checks are forged every year?
It's mind-boggling, and it really highlights the importance of exploring those more secure payment methods, which, thankfully, the book dives into.
Okay, so let's talk solutions. What are some of these alternative disbursement methods that can offer better protection and maybe even save us some money in the process?
Well, one option that's becoming increasingly popular is using zero balance accounts, or ZBAs.
ZBAs, okay.
Yeah.
Refresh my memory on those. How do they work again?
So think of a ZBA as a specialized checking account that's linked to your main operating account. The key difference is that a ZBA starts each day with a zero balance.
So it's like a blank slate every morning.
Exactly. And then, at a specific time each day, usually in the afternoon, the bank looks at all the payments that need to go out from that account and transfers in just enough money to cover those payments.
So you're never holding more cash in that account than you absolutely need for that day's transactions.
You got it. It's all about efficiency. And by minimizing the amount of cash that's just sitting there idle, you're reducing your exposure to risk.
Smart. And I remember reading about another method, controlled disbursement accounts. Are those kind of similar?
They are, in the sense that they give you more visibility and control over your outgoing payments.
Walk me through it. How does it work?
So with a controlled disbursement account, you'll receive an early morning notification from your bank, like a little financial heads up.
Oh, so you know what's coming down the pipeline before it hits your account.
Exactly. They'll tell you all the checks that are scheduled to be presented for payment that day, so you can make sure you have sufficient funds in the account. No more overdraft surprises.
I love it. It's like having a crystal ball for your cash flow. And what about that positive pay system I've heard about? Is that something the book recommends?
Absolutely. Positive pay is like having a personal bodyguard for your checking account. It's a fraud prevention tool.
I'm all for beefing up security. How does it work?
It's pretty straightforward. You give your bank a list of all the checks you've written, check number, amount, the works. And then when someone tries to cash or deposit one of your checks, the bank cross-references it with your list. If it's not on the list, red flags go up.
So it stops fraudulent checks dead in their tracks.
Precisely. It adds that extra layer of protection, which, let's face it, is more important than ever these days. We've talked about so many great strategies today, from understanding cash inflow, float, and credit evaluation to optimizing our disbursement methods. If you could distill it down to one key takeaway, one golden nugget of wisdom, what would it be? It really all boils down to this. Cash flow is the lifeblood of your business. You need to treat it with care, track it closely, and make those strategic decisions that will keep that financial blood pumping.
Well said. And if you're ready to dive deeper into the world of cash flow optimization, I highly recommend checking out Optimizing Company Cash, a guide for financial professionals. It's packed with even more insights and strategies to help you make those smart financial decisions.
It's an invaluable resource.
Absolutely. Thanks for joining us for this deep dive. Remember, knowledge is power.